Hi everyone, it's Spencer Hakimian and welcome back to another episode of What's Moving Your Money. On today's episode, we're going to dive into the latest inflation numbers and we're going to look into whether or not inflation is making a comeback. I personally think it is, and I'm going to explain why in this episode. So enjoy, sit back tight, and get ready. So yesterday, CPI numbers came in and they showed that inflation for the month of June had grown annualized at a pace of 2.7%. Now that compares to the estimates of 2.6%. And yes, on the surface, it does not seem like such a big deal that inflation only beat by 10 basis points. But, and I want you to look at a trend here because economics is all about trends. It's not just about, the raw numbers. In April, we had inflation that was 2.3% year over year. Then in May, we got inflation that came in at 2.5% year over year. And as I just said, in June, inflation was reported to be 2.7% year over year. So we keep going up on these inflation numbers. And that's a very alarming trend. If you guys recall, back in 2021 and 2022, we did not immediately go to 9% inflation. We started at 3, then we went to 4, then we went to 5, then we went to 6, then we jumped up to 8, and then we peaked at 9, right? It takes time for all of this to go through the system. But given the fact that we are seeing some of it head through in the system already, I think we have to be very cautious about this going forward. Now, as you all know, inflation is devastating for an economy, and it's also pretty bad for asset markets. If you remember, in 2022, it was the worst year that financial markets had since 2008. Beyond that, it also wrecked the modus operandi of most portfolios in the United States, which is called the 60-40 portfolio, which is 60% stocks and 40% bonds. Bonds get killed with inflation. People that are living on fixed income, fixed wages, they get destroyed from inflation. That's one of the reasons why inflation is so politically unpopular, because inflation really tends to hurt older people, poorer people, people that are living on fixed wages, and those people tend to vote quite a lot, right? And we also, President Trump rode that inflation fear back into the White House in 2024. Now look, one other thing that is really alarming that caught my eye in yesterday's report, and again, no one really spoke about, is we are seeing very rapid surges in inflation in a few categories. They are apparel, furniture, electronics, and specifically home goods. So stuff like refrigerators, microwaves, ovens, things of that nature. Since April 1st, just until the end of June, as it's measured by CPI, those categories had recorded already cumulatively 5 percentage points worth of inflation. So if those items costed $100 on April 1st, as of July 1st, according to CPI, that cost $105. That is 5% inflation in 90 days. Annualized, that's about 20% inflation. That's unsustainable, right? Ironically, or probably not ironically, these are the categories that we most heavily tariff from places like China, Vietnam, India, Bangladesh, you name it. So some people are saying that this is proof that we are already seeing a pass-through in inflation from all those tariffs. And I absolutely agree with it, right? I believe some of this is actually that companies are taking advantage of how much tariffs were in the headlines in the past couple of months. So they're raising stuff even though we had a pause on our tariffs, right? One of the big risks with doing tariffs was that, as we saw back in 2022, when prices rise, prices never fall. That is the most basic economic rule. Every ninth grader in this country can tell you that. Prices never fall. They do not reset. They stay at their higher level, right? So companies got an advantage to raise prices in early April. And now, even if those tariffs are not in place, they are keeping those price hikes in place. So in a way, we're really getting the worst of both worlds here, right? Because we're not necessarily getting the full amount of tariff revenue that we otherwise may have gotten if we kept those tariffs on, right? And we're also suffering to some extent from those price hikes that we were fearful that tariffs would bring on. So Again, we were speaking about this all spring long, and unfortunately, it's beginning to materialize. And a recurring theme on this show that I've told you guys time and again, my job for you guys, for myself, for my clients, for everyone, is to spot problems ahead of time. There is no use in 2026 figuring out something that was happening in 2025 because markets react and it's over with, right? So my job is to be proactive, which is why I'm focusing a lot on this inflation report, whereas most other publications probably aren't even going to talk about it, right? And if it's 1 month does not make a trend. 2 months doesn't even make a trend. 3 months doesn't even make a trend. But it's worth noting these things because if in 30 days, again, the inflation numbers pick up, particularly as it relates to those categories, electronics, apparel, home appliances, furniture, things of that nature, we really have to start getting cautious here. Now, if we go into market pricing, and as you know, as I'm sure you know about me, I am the type that says the market is always right. The wisdom of the market is better than the wisdom of anything else. The market is the cumulative estimate of everyone that's participating in the market. It is an aggregate of all the bets every participant in the market, not only in the United States, but around the world is making. So I believe there's tremendous wisdom in looking at market prices. Well, what did the market say to today's inflation report? Bond yields spiked. The 30-year yield rose above 5% for the first time since June. And before that, it was April. If you recall, back in early May, Scott Bessent had essentially told the whole world that the reason he was able to get President Trump to back off those tariffs was because the 30-year yield rose above 5%. Now, the 30-year yield is very important because a lot of lending to the actual world bases itself off of the 10 and 30-year yield. So home loans, auto loans, car loans, renovation loans, business loans, any type of long duration consumer loan you can think of is based off of the 30-year loan. So with that rising, real borrowing costs to the actual economy are rising as well, right? We already know we have a consumer that's slowing down quite a lot. We already know we have a housing sector that's really frozen, right? We already know how much uncertainty businesses are facing with all of these tariffs. If we add on to this entire puzzle rising bond yields, it becomes awfully difficult for an economy to continue sustaining at a solid pace. And that's a fear that we have, right? So another thing I just want to quickly highlight is this has all happened during the period of June when tariffs were in a sort of a lull, quote unquote, where there was less tariff noise. Taco was going around, Trump always chickens out. People thought that, that the worst of the tariffs were behind us, and we still printed these rather bad numbers, to be frank, right? I have a fear that, as you've seen in the past couple of days and the last week, we are going back to talking about those tariffs. All the countries around the world, Brazil, South Africa, Canada, Europe, Mexico, Indonesia, you name it, all these countries are getting brand new tariff rates. And they're as high, if not higher, than they were back in April. So what happens if we actually go through with tariffs, right? How is inflation not going to pick up from here? How is that electronic inflation, apparel inflation, how is it not going to keep spiking up from here? Do we get a 30-year that climbs closer towards 6%? I'm not saying it will happen, all right? My personal take is at the end, Trump always does chicken out. I agree with that. But we have to stay vigilant about it because if it happens, we have to be on top of it. We cannot be reactive. We have to be proactive in these markets. So I'm going to end on one final thing here. There's been a lot of talk, especially from Trump and his Truth Social posts, about the Fed cutting rates. He's suggesting a 300 basis point cut. Don't take him seriously. With all due respect, just don't take him seriously. We didn't do 300 basis point cuts in 2008 or in the peak of coronavirus. We're not doing it right now. There's no reason to do such a thing right now. But beyond that, more in, traditional economic thought, how do you cut rates with inflation on the rise, right? That is a formula for disaster. That is exactly how you get a lost decade like the 1970s. That is exactly how you get a second round of runaway inflation to follow on the first round in 2022. That is exactly how you get a loss of credibility with your monetary policy. That is exactly how you get your dollar, your currency, to lose another 20% of its value in 6 months' time. Do we want any of that? I definitely don't. So I don't see how we can cut much here. The market is currently pricing in 2 rate cuts for 2025. As of now, I don't think we're getting any rate cuts in 2025. I could always be wrong, but we'll see. And look, we have to monitor all of these things very closely. So again, this was today's episode. And on tomorrow's episode, I want you to tune in because bank earnings have started. And commercial banks, in my opinion, are the most important sector in the overall economy because they have their hands everywhere. They impact every single part of the economy. So we can get some very good insights from not only the earnings that banks report, but also from the commentary that their executives are willing to provide. So thank you for watching today's episode, and I hope to see you guys again tomorrow.